Hello all, this is Keertana, Assistant Professor, Department of Commerce. So today I am here to present the lecture series on the subject Direct Tax Law and Practice on the topic Transfer of Capital Asset. So in the previous videos we have seen direct tax, residential status, income from house property, income from salary, profit and gain and all. So now we can see the transfer of capital asset. So first we can see what is capital asset. Capital asset is a property owned by an individual or a business such as real estate, stock or collectibles. So kindly check with the examples to get a clear view. And what are the significance in taxation? Is this transfer of capital asset can result in capital gain or losses, impact tax liability. In regulatory framework, which is we have the tax laws including provisions under Internal Revenue Code, which is IRC. In the US govern the transfer of capital asset. So capital asset is nothing but owned by an individual or business such as real estate, stock or collectibles. So what are the types of transfers? So we have the four types of transfers you have seen in the screen. First is sale of asset, gift transfer, exchange of asset and inheritance. So first we can see the sale of asset. So the most common method of transferring capital asset is through sale. So this involves a buyer and seller with tax implications based on the profit realized from the sale. So sale of asset is nothing but transferring the capital asset through sale. So that is common. So this involves buyer and seller with tax implications, which is with the followment of tax laws and rules based on the profit realized from the sale. And the second one is gift transfers. So when capital asset are gifted, the donor may need to consider gift tax implications. So the recipient may also face future tax liabilities based on the current asset fair market value. So next is exchange of asset. In certain situations, assets can be exchanged for other assets, so which may differ taxes under specific provisions such as like-kind changes. While coming to inheritance, transferring capital asset through the inheritance can lead to step-up basis in impacting the capital gain owned by the sale of asset. So we have the four diagram, which is four types: sale of asset, gift transfer, exchange of asset and inheritance. So these four are the main things. Kindly note this as hints. Next is what are the tax implications we will face. First is capital gain tax. Next one is loss deductions and next is record keeping. So these three is the main important tax implications. One is when a capital asset is sold for more than its purchase price, the profit is subject to capital gain tax. So understanding long-term versus short-term capital gain is essential for tax planning. So capital gain in the sense, while the capital asset is sold for more than its purchase price, that is capital gain tax. So while coming to long-term or short-term capital gain, tax planning is compulsory for all the process. Next is loss deductions. So if a capital asset is sold for less than its purchase price, the loss can often be deducted from taxable income, potentially lowering the overall tax bill. So while comparing the first 2 points, you might got the clue, right? Capital gain in the sense whether while selling more than the purchase price, getting the amount is capital gain, and while selling lesser than the purchase price is loss. That's it, the concept. And next is after this process, we should maintain the accurate records for the purchase price, sales price and any improvements made to the asset is necessary for calculating the capital gain or losses to ensure the capital loss. And next is strategies for tax efficiency. So what are the strategies to maintain the tax efficiency? First is timing of sales. Next is utilizing losses. And next is tax advantaged accounts. Strategically timing the sale of capital asset can minimize tax liabilities. So utilizing the losses is taxpayers can be useful for the capital losses to offset the capital gain. So taxpayers can utilize the losses to offset the capital gains. So next is tax advantaged accounts is utilizing the IRA or 401 subsection K can differ from taxes on capital gains. So while ending, kindly note this as conclusion and best practices. So while conclusion, tax professionals or financial advisors are a must important for the taxpayers to keep advanced about the tax laws and regulations to for the personalized strategies to maintain the capital asset transfers and minimizing the tax liability. So only the professionals or financial advisors can give an insight of the problem or this or we can get the solution for the problem we are facing to the tax related. Next is staying informed. Actually, tax laws are frequently changes. Yes, we all know that taxes or tax slabs or tax percentages are always frequently changing, so that we should be stay updated on the current trends, which is current regulations to regarding the capital asset is essential for tax optimization. So planning ahead. While coming to the next step, understanding the timing, method, tax implications can lead to significant financial improvement. So getting to the plan is not easy. Before that, we should consult the professionals and we should know about the tax laws. Then only we can plan and go to the next process. So hope the video was useful and thank you for the cooperation. Thank you.